But Erin owns a company called Level Accounting and Advisory, and definitely a strong follow on social media. If you don't follow her already, do so, because she drops a lot of game for accounting stuff, raises a lot of questions that we should be asking ourselves routinely in business and when it comes to accounting and financials and all of that kind of stuff. I'm going to let her kind of introduce herself as well and then take over, but she definitely knows her stuff when it comes to the financial world and tax strategy and everything else. So, Erin, have at it.
Thanks, Mitch. Yeah, I'm Erin Andrews. I've had my business for about 19 years or so, and we have worked with contractors of trades that entire time, but really just leaned in about 7 years ago. So we exclusively work with home service-based businesses, contractors. But I'm located in Florida, but we have a hybrid team. We have clients in about 35 states right now. And I really just am here to, if you guys have questions, things like that, we can talk about what you should ask for your accountant thing, whatever. Accounting and tax can be super boring, but I think knowing certain things about your business is really important to know, like numbers and tax liability and all that stuff. Otherwise, you can't really be successful at scale without knowing the data. I guess first, does anybody have questions that they want to get, burning questions? And I can't really give specific tax advice because everybody's situation is different. But yeah, any question?
I do. It's regarding the difference between the track lease and purchasing a vehicle when the payments are the same, taking the full to bonus depreciation versus putting that as a lease and it doesn't show up on your balance sheet. Just if you had an opinion or advice on which one, if dollar for dollar they're the exact same, tax wise, does it make a huge impact?
Okay, I'm gonna write that. I'm writing some of these down. Okay. Anybody else?
I've got one for meals and entertainment. What determines the difference between 50% deductible and 100% deductible on meals and entertainment?
All right. Okay. Just writing. Determines. Okay.
Say it's 200 oysters are not tax deductible.
You know?
And a lot of things have changed, so I'm going to have to look
Yeah.
up. Anybody else that like more general questions about numbers, like KPIs, things that you should be tracking, bookkeeping, paying yourself, S-Corp, entity, anything like that?
Anybody? I've got another one too that I think I know the answer to, but I don't think the guys do, is what are some things that they can look into for how to save money over a tax year without paying taxes on the savings? Let's say I have this big $100,000 investment that I'm going to make next year, but I'm trying to save $50,000 this year, and then I'm going to put $50,000 with it next year. How can I avoid paying tax on the $50,000 this year so that I can spend it next year on something that would be a tax deduction?
Okay. Now I'm going to ask you more questions about that in a minute, but okay. Hey. All right. Okay. So one of the things you had asked me to Mitch before was like what you should look for in an account, like what you should be doing and things like that helps. Did you want me to talk about that at all?
Yeah. It's always nice to know, like one of the things that I always tell people is if your accountant's always pushing to file an extension, that can be a red flag that they're not, it's delaying your performance scorecard. It's hard to know how well we did in business last year and what changes we need to make if we're not even filing taxes until September of this year. Obviously, it's a case-by-case difference. I say that, and our accountant filed an extension this year, but that's because we sold our business last year, and it was very complicated, and so we didn't really have a choice on that. But obviously, there's reasons to file an extension, but that's just one of the early, easy warning flags that I tell people about, like red flags for accountants.
Okay. All right. So who here has an accountant that they use regularly, not just like to go file it? Okay. How about who here just only uses an accountant to file your tax at the end of the year? That's it. Anybody like
Dan?
Dan? Okay. And does anybody else here do tax plan? Have it at like a proactive relationship with an accountant throughout the year, and you do tax planning, you keep your books up to date? Jefferson. All right.
That's what we did
Good.
in ours.
Great.
Quarterly meetings
Perfect.
with the
Okay.
tax people.
All right. So the first thing I guess I would say is that's really, you should have a relationship with an accountant on a regular basis, year round, because when someone brings, people always say, I'll come to you in January. If you come to me in January, there's not really much an accountant can do to save money on taxes at all once you come in January. There's a couple things, but it's putting in money in a retirement account or something like that, or making some adjustments for the prior year. So if you're trying to save money by just using your accountant to file a tax return, they're just providing a product that it's a piece of paper essentially, and they're handing it to you and just saying that's it. So I guess if I was to recommend anything, it's to have a relationship with an accountant year round and do tax planning or projection once or twice a year at a minimum. Just, it depends on the size of your business. Not everybody needs it twice a year, especially if you have a pretty good relationship and with your accountant, and they always keep a pulse on your books and will reach out if something happens. But if you're not doing something at least around October or November, just to take a look at where your profit stands and if there's anything you should be doing to reduce your tax or just get a handle on things, you're probably throwing a lot of money away when you just file at the end of the year. I'm sure a lot of you have experienced that, which is probably why you now have accountants year round, a lot of you. Does that resonate with anybody? Yeah, I'm sure it's not brand new news. Anybody? So, and people always say they're trying to save money on taxes by having it once a year. In reality, you're probably actually losing a ton of money because of that reason. And then also the other thing I would always recommend, obviously, is have your books up to date and clean. And what I mean by clean, I mean if you have an admin, if you bring in an admin and they say, oh, they're going to do my bookkeeping, just because somebody learns how to use a program like QuickBooks does not make them an accountant. It makes them know how to use a program. They don't know how to do accounting. So you should have somebody that actually knows what they're doing when they do your bookkeeping, not just somebody that you're paying $20 an hour to part-time that is going in and entering stuff from your bank account, your credit card. I can't tell you how many books we see. It's almost every single one where, oh, my admin does my books, or my wife does my books, or we call it Great Aunt Bertha. She does the books, just because you're trying to save money. Also, those books should be like, you should be looking at your book weekly. I think weekly at a minimum, or maybe monthly. But so if your books aren't up to date and you can't rely on the numbers, it's like you're just blind to your business. You have no historical information. You can't look at stuff, forecasting or projection at all. I always look at my prior year comparison to this year. I want to see how things change. You can't see if like you're overspending in some areas. Let's say marketing as an example, you're just all of a sudden it's just up like 50%. You had no idea why it went compared to last year. Like, what's going on? I need to look at that because the leads aren't coming in. They're not matching, reflecting that change. So it's really just super important to invest that money into someone that can actually do your bookkeeping on a regular basis. And because like, if you want to go for a loan, it's very hard to get a loan if your books look like shit. Sorry.
We're all plumbers
Also,
in here. You're not going to offend
okay,
us.
good. That's why I always work with them. Okay, good. And then also, let's say you want to sell down the road. I think if you have clean books, I believe it increases the value of your company by about 30 to 40% alone, just having clean books. Because imagine a buyer coming in to look at your books and you have Home Depot in materials under cost of goods, and you have it under small tools and equipment on where your overhead should be. And you just shit's all over the place. You have no idea what your overhead is versus your cost of goods. That's just a nightmare. And then that will delay the sales process, and it will most likely get you a much lower sales price too. So everybody builds a business. We don't always have the intention of selling, but eventually you're going to sell or do something with your business. So that should always be in your mind. What can I do to have the best looking business possible? And it starts with clean books. And things like sometimes like an admin or something will know, owner draws. They'll just put it on the profit and loss or something like that, which will then falsely decrease your net income, and owner draws are not an expense. Or like a loan payment. I always see those on the profit and loss. That's not an expense, that's a loan payment. So this is why you need clean book. It affects so much more than just getting your taxes done. And then there's also the tax implication. What do you think about that? Does that make sense?
I like it.
I do this.
I like what you were talking about, building a sellable business, not because that's the goal to sell, is because that's like I tell our guys all the time, owning a sellable business is a great business to own. And I can speak firsthand into when we sold our business, we were able to get more for it because they had confidence in what they were buying because our books were so squeaky clean.
Yeah. Yeah.
I mean,
Yeah.
I love bragging about the fact that we would go to date night every Wednesday night and the business would pay for date night.
Yeah.
Because it was a meeting between my wife and I. And so we let the business pay for it. And that is as dirty as our books got, was that.
Yeah.
And makes it really easy to give somebody confidence in what they're buying.
Also, a lot of people, we own businesses. Yeah, we do have a little discretion we put through our businesses. If you have a cell phone bill for your family, we're probably going to we're going to put it through the business. Okay. As a cell phone. That's why we own businesses. But the more personal crap you put in there, the more it just muddies up the books and you don't actually know how your business is doing. So it just gives you it's just the false reporting essentially. So it's very tempting to start throwing a lot of personal stuff in the business because it looks like it could be business, or you just stuff it in office supplies or something like that. But I used to do it. Now I'm looking at my thing. I'm like, dude, I need to actually see what my business is doing. Because to be honest, the chances of getting audited as an S-Corp are very low too. So people do it all the time, but it doesn't make it right. And it really just makes things a mess. So just a suggestion too, just get your personal stuff out of your books. You run a business. And also people say, I don't want to pay tax. And I totally get that. I do. But then if you want to go get a loan, how do you get a loan if you brought your income down? And how do you expand because you don't want to pay tax? So there's different ways you can mitigate tax, but sometimes you just got to suck it up and pay the tax because you showed a profit. And that's why you're in business, is to show a profit too. Yeah. Those are my soapbox about that. So let me just see here. Does anybody have questions about bookkeeping and things like that? It's really sexy stuff. I know. No. The other thing that I've been teaching this class a lot and for other groups, and it's about knowing your numbers, meaning specifically not necessarily accounting numbers, but I guess some of it's accounting. Gross profit percentage, like overhead, your labor burden rate. How would you calculate your labor burden rate to do job costing if you have no idea how much the labor actually costs you because your accounting isn't done well? So all these things trickle, like even just your cost per lead, your client acquisition cost or customer acquisition cost. All of these KPIs that you should know about your business, you can't know if you have crappy books or you're not tracking it at all. And those are the things that really help me and help our clients figure out forecasting in future. So if you know something like your client acquisition cost, or you know your cost per lead channel because you're tracking and counting, and then you have the lead source coming in, then you can actually future forecast out what to expect to spend for marketing based on all your other metrics too. So it really helps not just with historical stuff, but from future planning, future goals. You want to hire a sales guy, you can give him exact numbers of what historical looks like for forecasting and prediction. Even if you want to hire someone on your team, project manager, you can tell him this is how long it takes us to complete jobs. This is how we do it under budget, over budget, things like that. It's a lot of work, but it pays off tremendously if you track your numbers really well. And it does start with accounting. So that's all I got to say about that. And then tax liability is a huge one. Does anybody here track their numbers or KPIs like pretty meticulously, or just at all?
They should be tracking them very meticulously. I know
Okay.
Erin does for sure.
What do you track, Erin? Yeah.
Yeah, I'm probably going to start cutting out. We're pretty saying some getting into the mountains,
Okay.
but big one for us recently has been average ticket. We've been pretty fortunate to where we're not doing a lot of spending money on leads, a lot of word of mouth, but with plans of growth here very soon. It's like, hey, days of I'm going to spend this $200 to $250 to get a caller, not going to be here much longer. So let's call it more. So I want to make sure our average ticket is at where it is.
Okay, you broke up. Okay,
Yeah, he's
so it's important.
driving in the mountains.
What do you like that? What if you had to pick top 5 numbers? in general for people to track? What do you like them to pick or track?
So we have our guys track number of opportunities ran per day, conversion rate, average ticket, number of tasks sold per job, and then weekly revenue are probably the top 5. If we're tracking those 5 things, we can usually use those 5 to drill down on where there's problems in the business. Now, that's on the front end, on the sales side of things. On the back side of things, when it comes to P&Ls and stuff like that, we have some benchmarks, some P&L benchmarks that we suggest they try to attain. And we know that not every business is going to nail all those benchmarks perfectly. Some areas are going to spend a little more in marketing than others. Some areas have to spend a little bit more in payroll than others and things like that. But if they're nailing 4 out of the 5 benchmarks, then that usually allows them to have a chance at the ever elusive 20% net profit that a lot of blue collar contractors struggle to achieve.
Yeah. Yeah, I agree. It's funny how the trickle down effect happened.
Yeah.
Yeah. Did you guys track your AR days? How long it takes you guys to collect?
Yeah. So that's going to change a ton from the mix of the guys in the group. I know in our company, our AR is almost nothing because we don't do terms. It's payment due upon completion, and that's just it. But some of our guys do a lot of new construction stuff and everything else, and they may have 50 to 100 grand sitting out there in AR. It's just the nature of the type of work that they do.
Yeah. I know. I always hate it when I get someone in and they're using a line of credit to pay their payroll, cover their payroll, and they have $750,000 in AR. I'm like, what are you doing?
Yeah.
It happens all the time.
You could solve this problem with a couple of phone calls.
Yeah, establishing a good collections process and deposits and all that stuff makes a huge difference. So
Yeah.
usually AR, how much AR is out there tells me how efficiently the company is running too, or they're just not cleaning it up or something. I don't really know, but okay. Anyway, okay. So for red flags, so you mentioned, I'm just going to jump around because that's what my brain marks. You mentioned going on extension could be a red flag.
Could be.
So red flag with the IRS now. The IRS doesn't care if you go on extension. They don't
Right.
care. So yeah, there's 2 reasons why clients like ours go on extension. They didn't get us the information that we needed to file the return, or there's a tax reason, like a very specific tax reason. Sometimes people you have to wait because they're going to put in money for retirement or something happens. So going on extension for the IRS, so just to clear that up, that doesn't put you on a red flag thing. You're not a higher likely to be audited by it. I will say that it's a pain in the ass to go on extension because you have to go back and remember what happened 18 months ago and try to rebuild things, especially if the books aren't up to date. If your books are up to date and they're getting reconciled and they're clean and the adjustments are being made monthly, there's really no reason to go on extension, especially if you're doing tax planning beforehand. Because if you're doing tax planning, essentially that is the preparation of the tax return, even though it's around November, December. Like when your accountant files in the spring or whatever, that really should just be putting together what was discussed in the fall or on Christmas time or whatever it is. It really depends on what your accountant's doing. So the accounting industry, we've lost 40% of our accountants in the past 6 years since COVID hit. So a lot of accountants are very overworked and understaffed. So they just automatically put people on extension.
Wow.
But if you're, it's a lot. So underfunding staff. So there's that reason. So, but the firms that have adopted the more monthly model, like if you're going to an accountant and all they do, you call them in October and you call them in March and they talk to you for 15 minutes and that's it. They're probably just a traditional firm. But if you get with a company that's doing monthly accounting, it's called Client Accounting Services, CAS, the CAS model, they should be more proactive in getting you prepared on top before the due date. Also, to be fair, most contractors are horrible at responding and get information to us when we need information. I get it. You guys don't want to, you're sitting in your trucks, almost all of you. That's how we deal with our clients. You don't want to go sit at your desk and look up some stupid form or a statement. I get it. But that's actually the reason why almost all of our clients go on extension, because they don't get the shit to the account.
Yeah.
Or respond to the question. I wish I could. I'm going to post this actually. But so if your accountant asks you a question, answer them. and get them the information that they need because they can't put their genie hat on. I have this genie hat because a lot of clients say, why isn't my return filed? And I said, let me put my hat on and tell you. She didn't give me the information. But going on extension, it is just a pain and also affects your personal tax return too, for almost all of you. And it's also the extension is due September or October, depending on what the entity is. The tax is due April 15th, no matter what. So people think they go on extension, they get an extension to file the tax, to pay the taxes. That's not true. You have to pay the taxes by April 15th. So you have to figure out what your profit is anyway, your taxable income. So why not just get the tax return done?
Yeah.
But yeah.
When you're paying guesstimated taxes on April 15th, what are they usually running off of? Are they just going off gross revenue? And then
No.
how are they coming up with that number usually?
So there's a couple different ways your accountant could do it. So the IRS isn't doing it. The IRS is just IRS will just look at your last year's tax liability and say that's what you owe. If your accountant's doing it, they're probably going to look at your 2020. What year are we in? 2026. Let's say 2025 is going on extension. We have no information for 2025. We're just going to look at 2024, say, hey, is it similar? We don't know. And use that. For 2020, if you do have information, you go off your net income. So what you think your taxable income will be. And that includes depreciation if you do purchase vehicles or equipment. So an accountant essentially should run, it's called a proforma tax return. So like a fake or a draft tax return to try to see what you would be. And also you take in, did you have a W-2 or a spouse have a W-2 with other taxes that they paid in? Did you make estimated payments? Did you have a W-2 through your company? So all that stuff goes into it. Essentially, we prepare the returns twice when you do that because you're doing a draft and then you have to go back and redo it.
Gotcha.
Does that answer your question?
Yes.
Yeah. So if it's just the IRS, they're just going to look at usually what your 2020, your prior year's tax liability was and just assess it at that. Or they just like to go extra. And they just hope that you'll get more. And that's what they do. Yes. That's a good question. But yeah. So if you can file your tax return on time, I recommend it. Then also it's easier to get loans and stuff like that too. It's just something, just get it out of the way and deal with it kind of thing. And talk to your accountant, please. Please, on behalf of all accountants around, just get back to me. If we had people that got us their information, tax season would be a breeze. Any questions so far? I feel like I'm just rambling.
No,
Tax.
Oh, you're good.
you're
Okay.
good.
Okay, good. I can talk about, does anybody have questions about entity like S-Corp, paying yourself like draws versus paycheck or single member LLC versus S-Corp entity? That's always a big question I've had.
We talk a lot about reasonable salary
A reasonable comp, yeah.
when filing as an S-Corp. What does the IRS judge that as? Do they hit the
So-
and say, okay, this guy should be making this? Or are there designated thresholds because you're in an area of work?
Yeah, that's a good question. So for everybody that doesn't know, if you're an S-Corp owner, so you could be like an LLC that elect S-Corp for tax status or whatever, but you're filing an S-Corp tax return, so an 1120F. The way that you pay in your Social Security and Medicare tax is by taking a reasonable salary. That's the reason why the IRS has you do it. Otherwise, people would never take a salary and we would never pay in the Social Security and Medicare tax. So we'd be avoiding it. So they said, okay, you have to have a reasonable salary. So whenever like someone wants to become an S-Corp, I'm just going to get a little background for this. So let's say someone's a single member LLC and they're like, I want to be an S-Corp. You want to make sure that the benefit outweighs the cost of it first, because you do have to file a separate corporate tax return. The accounting is stricter, it should be. And then you do have to put yourself on payroll, which is an added expense. So you want the benefits outweigh the expenses. As an S-Corp owner, you have to take what's called a reasonable salary. Now, the IRS doesn't have, they have definitions on this. It's basically what your market rate could be if you were replaced in the workplace. So whatever your job is, and for business owners, that's a lot of money because we're very hard to replace us because we do a lot of things. It's basically, I'm trying to give you the actual, like the technical answer. Yeah, it depends on your training and experience, duties and responsibilities, time and effort devoted to the business, comparable salaries, like what you would pay someone else to do this job, compensation, blah, blah, blah. But when we get a client, we give them We determine their reasonable salary based on reasonable comp. As long as they have, I can't give a number. It really depends on how big the company is, the net income too. If you have a lot, it's not really super reasonable to take a salary, but then as a business owner, but then you really shouldn't be taking distribution from the company. So just writing yourself like, oh, Mitch Smedley checks either, but you have to get paid somehow. So there's this balance that you have to do. So we like to just, okay, hey, basically what can you afford as a paycheck? Because a lot of people can't afford a big paycheck because they're also paying taxes to it, or sometimes they can. But we also don't want to give it too large of a paycheck where the benefit of not paying Social Security tax is too high. So it's a balance between distributions and reasonable comp. This is not a cut and dry answer. There's no accounting it. Okay.
Yeah.
It's a legal thing. Our goal is to probably give them what I consider reasonable, which is probably $60,000 to $75,000 a year, unless they're really profiting a lot. And then we like to pay in as much of their tax liability through that paycheck as a tax planning tool as well. So I'm not directly answering your question, but it really depends. So a lot of us, if we had to hire ourselves, that's probably going to be $150,000, $200,000 at least in the market. You're a hire project manager plus everything else you do. I'm not going to have somebody do a paycheck like that. I'm not, because that's stupid. I'm not doing that. But as long as you're not showing 15 grand for a paycheck, you have to just show that you're paying in self-employment tax, the Social Security and Medicare through that paycheck. So again, it really depends. That's a really good conversation to have about specifically your business, and also the distributions have to balance that as well. But back to the tax liability, we like to use that because let's say you owe taxes for the year, you have tax throughout the year. It's a great tool to actually pay your taxes in through the business versus writing them a check just individually. If you were just to write your estimated tax payment on your own, that's just paid by David to the IRS. If you're doing it through your business, at least you can have that come through your business, as it's kind of a deduction, like your wages are a deduction too. So you can still reduce your profit by those wages. You still have to report the wages on your personal return, but at least you're paying your taxes through the business versus writing them an estimated tax payment check. Does that make sense?
Yes.
Yeah. So we use that
Essentially,
as a tax management tool as well.
Essentially, it sounds like as long as you have the data to back up whatever you're claiming is your salary,
Yeah.
you should be good. Like that $200,000 a year project manager that you were talking about, that's not $200,000 a year salary, most likely.
Mhm.
That's probably $100,000 in salary and $100,000 in bonuses based
Mhm.
on performance of the projects. And one of the things that we like to tell the Tradewinds guys is your managers that you're going to hire to replace you and all of that stuff, they're not going to take a straight salary. They're going to have a lower salary, and they're going to have some performance bonus in there as well. And so there's no reason that you can't set your salary low, and then your disbursements are your performance bonus. And especially if you write it down and you have some kind of a structure to say, I'm going to salary myself at 75 grand a year. And then anytime, if you have some kind of a disbursement structure that if net profit says this, then I take this much of a bonus. And if net profit says this, then I take this much of a bonus. And I've never seen anybody running into troubles with the IRS doing that.
So one of the red flags. So I'm not a big red flag kind of person because the IRS is very random. They actually, knock on wood, the rate of auditing like an S-Corp is incredibly low. Like they will actually more look at Schedule C. So if you're like a single, that's a much higher. And if you have high mileage, that's like a huge red flag. But other than that, they just all over the place. But if you are an S-Corp and you are not taking wages, that is a red flag. They actually just, I think like part of the big, beautiful bill, they actually put an IRS task force together specifically to audit S-Corp that do not have owners taking wages, like W-2 wages. Have I seen that yet? No, I don't know any of my friends have. I have colleagues. I'm very involved in the accounting world, but it's just something to be aware of. So as soon as we get a client and they haven't been taking wages, we at least set them up on something small just to get them going. So at least they can show they have they have something, as long as they have a profit, that makes sense. And also on the flip side, if you're like a single member LLC and you have not elected S-Corp, you cannot take wages. You cannot. So people come to us, oh, I'm the Schedule C. I set up payroll for myself. I'm like, oh my God, you can't do that. It's just out of compliance. So that's a weird rule nobody really knows about unless you're in accounting. So I think you guys are understanding. Probably a good idea to have an accountant because it's very nuanced with all the stuff that goes on. It's not cut and dry. So if you aren't an S-Corp and take a salary, that's a problem too. Yeah, I said that right.
Yeah.
I did? Yes, okay.
If you're an S-Corp and don't take a salary, that's a problem. If you aren't an S-Corp and do take a salary,
That's a
that's
problem.
also a problem.
That's also a problem. Yes,
Yeah.
yes. So, yes, everything has to be amended and paid back and all that jazz. So, and then also, since we're on the topic of payroll, people say, oh, I don't want to go to jail from paying taxes or not paying taxes or for my taxes. One of the taxes that will cause you to go to jail is if you have payroll for your employees and you do not pay their taxes for them because you are considered a trustee of that tax that you're collecting on their behalf and remitting for them to the IRS and the state. If you don't pay those taxes, but you're withholding them from your employees, that is a go to jail tax. That is that is put padlocks on your door of your business tax. I've seen it happen because it's a trust tax as you're holding those for your employees. It's payroll and payroll taxes can add up very fast, and the IRS is not nice about them. It's same thing with sales tax for the state as well. So if you're collecting any tax on behalf of somebody else and you're supposed to pay it out, pay that tax. Yeah. Okay, good.
I
All
hope
right.
we have nobody in Tradewinds doing that.
Yeah. Sometimes it happens and they don't even realize it. A lot of times we see payroll being done on QuickBooks. QuickBooks is my nemesis when it comes to payroll. And it's just not set up right. And the business owner doesn't realize the taxes just aren't being paid in because they're not really paying attention. And all of a sudden, 6-8 months have passed. And it's like, holy shit, I owe them $45,000 plus penalty. That's a whole. So it does happen, not necessarily on purpose. It's a lot harder now. Back like when I first started 20 years ago, it was a lot. People processed their own payroll by hand or handwrote checks. And you had to physically mail in a voucher for the IRS. That was a lot different back then. Now a lot of payroll just collected automatically and paid in, which is great. So that's just my go to jail tax conversation.
Yeah.
About that. Okay. Let me just see here. I'm going to talk about the truck lease thing. And I'm going to be I'm good at tax and all that stuff, but I haven't studied the Big Beautiful Bill as much as I want, but I can give you guys some ideas with depreciation on lease, fine, like that. Any other options until I talk about that? So I want to talk the truck or the meals and entertainment first.
Doesn't matter. You pick.
All right. So I'll do meals and entertainment first. So entertainment, you cannot deduct anything entertainment anymore. So you go golfing, you go to the strip club, a lot, actually. Those are not deductible. It doesn't matter who you take. So, which kind of sucks. I think that's actually, I don't know why they got rid of that. But so there is no such thing as entertainment at all. The only kind of caveats with entertainment is, let's say you have like a party, like a Christmas party for your clients and your staff. It's not really entertainment, but you could do something like that. But you can't take them to Cirque du Soleil and pay for that. It's that Cirque du Soleil portion is not deductible. But if you bought food there for your client, then that is, what is that? That's 50% deductible or 100%. Which one? Oh, the customers. That's why they keep changing this. It's so stupid.
It's kind of when you get a cabana.
Oh,
Yeah.
stop.
You can list it as marketing and
Cabana.
advertising.
You got to dig
Yeah,
that one in
that's
on
it.
me, huh?
Yeah.
You have
Yeah.
food and drinks. Hey, dude, our accountant said it's fine. It's
Yeah.
marketing, it's fine. We're good.
I know a lot has changed. One of the ways that it was explained to me in the last year or two was that meals that are a fixed benefit to the employee are deductible, but discretionary non-fixed benefit meals are not. So in our company, we provide breakfast at our Wednesday morning meetings every week. And they said because that's a fixed benefit and they're required to attend the meetings and everything else, that those meals are deductible as a benefit to the employee. But like whenever an employee performs well, or you just want to take them out to lunch randomly, those are not deductible.
So that's changed.
And yeah, that may have changed with the passing of
Yeah.
the big beautiful bill.
It did.
Yeah.
You're not even supposed to. I buy snacks and I buy lunches for my team all the time. It's for their benefit or lunch and learn. That's
Yeah.
not deductible anymore.
Interesting.
It's 0%, which is wild. So that's now what's crazy is everybody's going to stuff that into office expense and make it 100% deductible versus 50% deductible because they're going to say, screw that. I'm not going to not buy my team coffee or buy them lunch at a lunch and learn. So yeah, that's not, it's 0% now. You can't buy so the cafeteria like Google has and things like that, like those giant things, those are 0% deductible now.
Wow.
Because it's, even though it's for the benefit. So yeah, it's been a big, even accountants are like, screw that. I'm stuffing it in office expense. I don't care what they say. So no, yeah, it's been a big, because you can't not feed our team now. That's expected. It's like a bar, like the base that we do. So
yeah,
that's what's crazy. It's still tax free to the employee if you do it. So you don't have to give them a 1099 for giving them their coffee.
Oh,
Well, that's good.
you want to hear a funny accounting story?
Yeah.
The second accountant I had that I ended up firing them for this, they made me 1099 my employees for our Christmas party.
Oh yeah, fuck that.
Yeah. That was the last time I spoke with that accountant.
You are supposed to, but who the hell's gonna do that?
Yeah.
Great. That's wild. That's insane. It's like giving them a $100 gift card. You're supposed to, but come on. So
No, they wanted me to, we took them to a show and we bought them dinner and they wanted me to 1099 them for the show and dinner. They're like, they didn't choose the show. They didn't choose I'm the one who chose all this.
Yeah.
Yeah.
people are, some accountants just need to get their sticks out of their butt. Okay, back to the example of if you take them to an event, the meals are 50% deductible versus 100%. If I took clients, if you took them to dinner, that dinner is 50% deductible. Also, if you're traveling, I believe it's 50%. That's still 50%. Yeah, it is. You changed this so much. I don't know why they have to make everything so complicated. So if you travel for conferences or work, then it's 50%. That hasn't changed as far as I know. Yeah.
I've got a question.
Oh, what's it the day trip? Yes.
If you are going to give an employee like a relocation / sign-on bonus, what is the best way? Number one, is all of that going to be taxable income for them, even if we were to go and pay moving cost? What's the best way to do that? To, number one, obviously make sure that everything's deductible for us, but also maybe not put that whole burden onto them.
That's a great question. Okay. So there's one second, because there used to be this thing. I haven't heard of relocation in a long time. 1 second. Just refreshing my mind. Fully taxable to the employee, which is great. But there is so you're supposed to gross up the employee's check. There is I don't know if it's just a state deduction. Sorry. There's
Because I'm being told from, I know, Dave, I think you said you kind of looked and you were seeing like kind of 50-50 on whether it was taxable for the employee. But then my CPA is also saying we're going to have to pay payroll tax and like all that stuff.
Yeah, and it's just considered an increase in their pay. I wonder if you pay that moving expenses directly, because there used to be a deduction for moving expenses, for relocation expenses on the personal return. That's gone now. That's what I was just thinking of, because you could offset it. Like you'd get an allowance and you'd offset it. God, that's gone too.
Yeah, they just changed that too, Erin. So we were talking about that the other day, and I was telling them, no, they can completely write that all off.
Yeah.
It's a bonus and it's a wash. But that was changed in that bill too. And the only thing I really couldn't get clarification on, Erin, was if you paid the moving company directly.
Yeah.
I couldn't get a straight answer from my accountant either.
Yeah, because they write these. I would, if I was to do it, I'd probably pay the moving expenses directly. And then
I told him, well, we talked about this too. Maybe just take the bonus of $10K The kid pays for his own stuff, does whatever. When the kid gets there, he just gives him cash. It's shady as shit, but I mean,
Yeah. Yeah. I would personally,
do the shady shit.
I don't know the shady shit. I can know I would not do shit. Yeah. But if it's $8,000, well, I don't know how much you're going to give him, 10 grand. If you could
It
just
was
pay
going
the
to be
moving,
10.
if you have a moving company, just pay the moving company directly.
And then chalk it up as an expense in his QuickBooks and roll on.
Just keep going. You're not really supposed to do that, but what are you going to give the guy a $10,000 bonus? You could do that. The technical way, the correct way, the guy a $10,000 bonus and pay tax on it. But that was good. Yeah. I can't believe they got rid of that deduction. That's terrible. That's irritating.
To be good for business.
A lot of that
Man,
stuff they got rid of, and I
scamming.
just don't get it. It doesn't make any sense to me. But whatever. Gonna make politicians happy somehow. Okay. So one of the questions about truck lease, bonus depreciation versus leasing versus buying.
Oh,
Yeah, Christian asked that.
Okay. I'm not gonna get because it depends on so first depreciation. If you don't have a profit, you can't depreciate something. You're limited by how much taxable profit you show. So let's say you have $30,000 in profit, but you bought a $65,000 truck. You can only take up to what your profit was. You cannot put yourself in a loss for depreciation. So you got to plan that out, right? Let's say, so there's stuff on your books that you might look like you have a profit, but after your accountant goes in and makes some adjustments and things like that, your profit could go down. So you need to make sure you actually know your profit before, let's say you don't really need a truck and you're just buying it because, you could use one, but I want to write off for the taxes. Make sure you actually can get the full tax benefit before you go spend the money on the truck. So does that make sense to everybody?
yes.
Yeah.
Yeah.
Yes.
So you can get 100% there's bonus depreciation. They keep changing the bonus depreciation rules on everybody. But so if you're under tax write-off, it's up to 100%. And then, so leasing is basically when you lease a vehicle, you just deduct the lease payment. So
So
as you pay
leasing
it.
is an expense, not a long-term liability.
Because you don't own the vehicle.
Okay.
Like renting a car to go there.
It's like renting.
Would leasing show up on the P&L then and not
Yeah.
on the balance sheet?
Yeah, on the P&L. Yep. For trucks, so under 6, so this is very technical. So under 6,000, you're capped at 20,000 for depreciation for 1 year write-off. Work truck, heavy SUVs, so 6,000, 14,000 pounds. I meant 6,000 pounds. Sorry, not just dollars. It's 31 to 32,000, then 100% bonus on the rest, usually a full write-off. Confusing. And then if you have a commercial truck, so over 14,000 pounds, there's no cap. You can do a full write-off. And then cargo van, truck, no cap, regardless of weight, full write-off. So it just depends. A lot of people are like, I'm going to go buy a truck. And I'm like, do you actually need to buy a truck? Don't just buy it, but you don't need it.
Learn your tax liability before you start trying to squander it away.
That's it. Yeah.
Yeah.
There's something else I was going to say that was important. What the hell was it? Did I write it down? I don't remember what I was going to say. It was actually important. That's okay. It'll come back to me. Okay, whatever. So it depends. So leasing or buying, it really just depends. That's actually one of the biggest questions we have all the time. Should I lease or should I buy? First, you need it. Yeah. And wrapping your truck, all that stuff, that's fine. You can do that too. What else do I have? I just had a really good thing to bring up. What the hell was it?
I hate it when my brain does that.
Yeah. Who else has questions?
Anybody?
That one that Christian asked was the first one I thought about the truck leasing.
Yeah.
Yeah.
Just depreciation.
Does anybody have kids here? Like under 18?
Having your
17,
kids work
18?
in the business.
That's like a hot topic on
We tell everyone to do it.
the TikTok. Yeah. So I pay my kid. You really want to start when they're 6 or 7. Doing them when they're really little, it's really hard to justify because they're so little. Unless
He's a
I get
3-month-old. He's
Yes,
on.
I have college. I don't have little ones. Anybody do? My daughter's 10, but like I didn't start it until they were a bit older. But it's just unless they're all over your social media or something like that, you do need to have it is a good tax strategy. So if anybody is interested in it, I could just tell you really quick because it's not as simple as people make it out to be. Basically, if like you're an S-Corp, you can't pay them through the S-Corp. You have to set up a separate, like a management company. So like a Schedule C or single member LLC, and you set up payroll through that. And you should have like their contract documented, like what they do, their duties, things like that. And then also they should have an hourly log for when they're working, and you should pay them what the market would pay someone else to do it. No, as long as you have the documentation there, you should be good. And what it does is you can pay them up to what the standard deduction is every year, essentially tax-free until they're 18 years old. So you could say, so let's say for my 10 and 14-year-old, they get paychecks up to the standard deduction. So the standard deduction changes, it increases every year. And so this year, I don't know what it is, 14,000 or something like that. But I can pay them up to whatever the standard deduction is, 14,000. I can deduct it from my business, full deduction, and then I can pay them. You have to pay them a paycheck. They have to be set up on payroll, but they're not subject to Social Security and Medicare tax. So they're saving 15.3% on tax, or you are. And they're not subject to federal or income tax either, or unemployment tax. So it's literally tax-free. And you just have to make sure you're filing quarterly tax returns, and has to be set up a very specific way, because most payroll programs will never default to not withholding taxes. You have to, because it's a very specific situation. But then you can take that. So it's tax-free to you, tax-free to the kids. And then they still get a W-2. All it does is shows one line on the federal and the state, depending what state you live on, how much wages they earned. And there should be no other numbers in the boxes. Then you could do something like set up a Roth IRA for them and stuff money into a Roth IRA. Like just use that. We use it for tuition because my kids go to private school. So it just goes, you know what I mean? That's just essentially does that. But I occasionally, like my kids will be working at the office. I'll take pictures of them there just so I have my proof. You know what I'm saying? So it's like, it's legit. It works. You just need to have your documentation.
And back it up.
Yeah.
Is it a red flag thing for the IRS? Or
Not that I've seen yet. It's very trendy right now, I will say. But my parents are accountants. They started doing it when I was 10. Like,
yeah,
it's been around for a really long time. So it's not all about, we all own businesses. My kids are here all the time. They work. So who's the IRS to say they didn't earn that money? You know what I'm saying?
It's probably very difficult. The burden of proof's on the IRS to prove otherwise, and it's probably an incredibly difficult thing to prove.
Yes, exactly.
Yeah.
So I was was here painting the office. Took a video of that, picture, stuff like that. Like if we're doing marketing events, they're always at our marketing event, working events, things like that. Actually, you just reminded me what I was going to say. So that's not hiring your kids. So it does need to be set up a very specific way. You can't do it through your S-Corp. So you have to set up, so it's a little bit extra bookkeeping and payroll stuff, but you can just set it up and set it and forget it. As long as your account kind of tracks that, it's worth it. If you have 3 kids that's a very large deduction.
So each kid is the 14,000 or 14,000 total?
Each kid. Yeah. Whatever that
We're just going to have this shit set up today.
Yeah. Now, George, are you LLC or S-Corp?
LLC.
You are, okay. Yeah.
So Ava's been on my payroll, my oldest. She's 21 now.
She's too old then. She has to, yeah.
But
She
my
should be under
bookkeeper,
18.
okay. I guess my bookkeeper thought it was till 21 because she just started paying taxes.
Oh, no, you have to be under 18.
And I mean, it's all through Gusto.
Yeah, Gusto is, yeah, they don't, it's the way you set it up, but
Yeah, Gusto they don't care what you do. They just, you set it up and it rolls. They don't, they tell you, oh, you're fucking this.
Yeah.
Gotcha.
yeah.
I was going to say,
They don't,
we did it with
Paylocity.
Paylocity with my older kid, and we just turned off all the taxes.
Yeah. But it has to be through a certain way. You can't do it through your S-Corp. You're not supposed to. But actually for 2026, the standard deduction is 16,100. Holy crap, that went up.
Yeah, I was going to say, I thought the standard deduction was 16.
Look at me.
About to put a broom in Jack's
taxes
hand.
in a while.
There
That's
you
a
go.
lot. Jesus.
Yeah, some bitch needs to be working.
Yeah, that's right. Yeah. My son's always, when are you going to pay me? I was like, you get paid.
Yeah.
That's right. You just don't see it.
Can you
That was-
claim your dog as a dependent?
Marketing.
Marketing and
Frenchie, it's very hard.
Chris.
Okay. I've actually looked into it because I just got
Chris, are you
puppies
in the
last
office?
year. Pain in the ass. If you can legitimately show there's some stuff you can do, but not everything.
There it is.
Oh, I have
Come on, Dave. Frank.
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 It's the freaking motto of Panette Plumbing right there. The
Oh, he's so cute.
mascot.
I have 2 Frenchies. They're a pain in the ass.
yeah.
Frank the
But-
money sucker.
Oh, Frank, he's cute. So you said something earlier, Mitch, about defend. So they have to prove it. So people always ask me, "Oh, should I write this off? Should I deduct this? I'm going on vacation. Can I write this off?" You have to reasonably. I always say to somebody, if you were audited, could you reasonably defend this in an audit?
Yeah.
Could you against the IRS? If you're like, hell yeah, I can prove it. That's fine. But if you couldn't sit there with an IRS agent across the table and defend that expense as a business expense, you probably should not be writing it off.
Yeah. Yeah.
That's just mine.
Some other advice I got. Now, this was back when meals and entertainment were deductible and everything else. Some other advice I got from somebody a while ago was to always run that stuff on your calendar. And even travel and everything else, because from your calendar, you can record. I went to lunch with Erin Andrews and we talked about accounting for my business. And so that right there, back when meals and entertainment were deductible, that's forever. And so if the IRS ever came and questioned a list of expenses and you were able to go back and say, okay, what date was that? Oh, that was August 18th of 2026. Okay, let me go check my calendar. Oh, I'm checking my calendar. It looks like I went to lunch with Erin and we talked about taxes and accounting for our business. And once the IRS sees that you refer back to your calendar 3 or 4 times, they're going to close everything down really quick because you're using your calendar as your record keeping. Yeah, your log.
Yeah, that's actually it. Yeah, I don't know how quickly they do it. They might do it like that, but definitely having a log. So I put everything in my calendar: travel, lunches, networking, whatever it is, for that reason. And because it won't happen. But so if you have, it's a log basically. Same thing with mileage. That's a huge one. If you're taking mileage, I hate when someone comes in. I'm like, oh, how much mileage did you do? Oh, just do the same as last year. I'm like, dude, that's gonna get disallowed, and that will get audited and get disallowed. If you have a log to back it up, even if it's just which customers you went to that day, like you go through your CRM, let's say or whatever, as long as it might take you more work to go back and defend that later on because you have to go back and look at everything. You didn't calculate all the miles, but as long as you have some kind of log to back that up, like he's saying, that's hugely important because then you can justify those expenses. So yeah, put things in your calendar.
I don't know if we have anybody in here deducting mileage simply because if the business owns the vehicle and the business buys the gas, then you're not doing mileage.
Yeah, it happens a lot with smaller schedule fee. If it's like the small plumber down the street or something like that. So it used to happen a lot more for small businesses or sales guys or something. I don't know. They do it, but yeah. So if you are doing something with mileage or like your team definitely needs to track stuff for you. But yes, a log, anything you can go back to and say, hey, this is it right here. Yeah. Calendar's perfect.
I have another question about paying the kids. If you are an LLC filing as an S-Corp, but have a business partner, so each one of you is going to get a K-1, how would that work? Would your kids' individual payroll come off of your K-1?
Oh,
personal tax liability, or
so it would be a business expense, like a shared business expense. Okay. So you would let's say you and your partner both have kids. You would set up a single member LLC, like a family management LLC in your own name, your own social security number that would go on your own personal tax return. It would be in the tax. You need a tax ID because you're registering with the IRS. That would go on your own personal tax return. He would have his own, but those expenses through the business would just be considered any other expense.
Okay.
So you might, let's say you have 3 kids and he's got 2. You might work something out where for equity, right? Yep. So that he gets a different deduction somewhere. He gets another expense or takes something else out of the business expense or something like that to make it equal, if that makes sense. So you're
okay.
Yeah. Good question. What else? Oh, 10:07. Crap.
Yeah.
I don't know how long these things
take. David listens to this, Alan. That's why I asked the question.
Oh.
Yeah.
Yeah. What else can I talk about? I that's pretty much,
Of good stuff.
Yeah.
was it?
Yeah.
Like, I never think people want to talk about tax.
Everyone wants to talk about money.
It's true. Money's good. Yeah. Yeah, that's true. But is it usually an hour or so?
Yeah. Yeah.
Okay,
We're
cool.
right at it. So you're
All
good
right.
there. So
That's
Well,
perfect.
yeah, if you guys have any question, I can give you my information, or you can just follow me on, like you said, Facebook is my biggest platform. If you are interested, you can set up a call. So how we work with our clients is on a monthly basis. All of our clients work with us monthly. So typically we're doing the bookkeeping on a monthly basis. Sometimes we'll have a thing where we just review the books, but tax planning, tax production, 1099, workers' comp liability audit, payroll. So yeah, we do. And I am going to have a webinar coming up. I thought we had the date. I don't know where it is. I am going to talk about your like specific numbers, KPIs and stuff like that through accounting, marketing and sales, job costing too. So I can let Mitch know about that when that happens.
Yeah.
Yeah, just give it to Mitch and I'll put it
yeah,
in.
shoot me that info and
For
we'll,
sure. Okay,
we'll
cool.
have it.
Yeah. All
Yeah.
right. Second.
All right.
All right.
Guys, in our Facebook group where I was letting you know that Erin was going to be there, I tagged Erin in the post. So you should be able to go click on her name in that post and find her. If not,
Okay.
it's just as it is here on your screen, Erin Andrews, and you can find her that way. Yeah.
Good
Other
stuff.
than
Here
that,
we go. Am I not part of your group? Am I part of your? Anyway.
I don't think you are.
Okay.
The way that we have the group set up, sometimes we can tag people,
Okay.
even though they're not members of the group, and the members of the group can still see the tag, but it won't send you an invite because it is a private group just for the trade
That makes
fund
sense.
members only.
That's fine.
But
All right, cool.
yeah. And then I just tagged Erin on my Facebook story with a photo of this meeting as well. So if you could probably find her that way as well. But yeah, shoot me whenever you have that webinar info and everything else. Shoot me
Yeah.
over that info, and we'll get it all squared away with the guys and get it announced to the guys.
Yeah, I'll
Right.
go with that.
Yeah.
Well, thanks, guys.
All right.
Thanks,
Yeah,
Aaron.
good question. Make tax
Yeah.
interesting. All right.
Well,
Have a good day.
yeah. Thank you very much.
Thank you, Mitch. I appreciate it.
Yep.
Bye.